Thank you, Joyce, for making time to come over here today as well to share with us more about the fund as well. And big congratulations on hitting the 2 billion mark in the United SGD Fund. So, as we all know, the headlines numbers have come in. The Fed is cutting rate. So, with the likely rate cuts ahead, what's going to impact the fund's yields and also on the returns as well? Any thoughts on that?
Definitely, with a reduction in interest rate, it will benefit the portfolio because there's always an inverse relationship between bonds and interest rate. So if the interest rate is reduced, your price of your bond increase. So overall, our portfolio should be registering better return if interest rate continue to decline from here.
I see. So as the Fed start to cut rates as well, where do you think are the corporate sectors that probably will benefit from this impending rate cuts coming from the Fed as well?
I would say lower rates lift all boats because we buy into bonds and these issuers are issuing debt. So when they issue the debt at lower cost, definitely is benefiting for them. So again, all sectors who borrow money will definitely benefit from a lower interest rate. So that will also help in terms of activity within the bond issuance market, because with lower rates, issuers will be increasing the activity by raising funds for their expansion, for their expenditure. So this will create better options for us within the universe for us to invest as well. So overall, it's a good environment in the lower interest rate environment.
I see. So that will be actually a very good and a positive news in terms of the funds and in terms of the macro environment. So since we are into that as well, we all know that United SGD Fund is a short duration bond fund. It's known for the duration of the fund as well. So any changes to the duration of the fund going forth?
Beginning of this year, we have been focusing on longer duration, 3-year. So coming into next year, 2025, we'll continue to do the same. So currently, the portfolio is around 1.3 year in terms of duration. So I would think that if we continue to focus on the duration of maturity at 2028 papers, it may slightly bring the duration just marginally higher to about 1.5, just 20 bits higher. The purpose is to make sure that we lock in the longer interest rate environment for investors.
Besides being known as a short duration bond fund, this is also an investment grade bond fund as well. So yeah, any changes in terms of the credit quality of the fund and the selection as well?
We do not expect to see much changes in terms of the average rating of the portfolio because the portfolio has been focusing around BBB, A- kind of credit. So it was just navigate along that few difference in terms of rating. So average rating unlikely to change that much from now. So likely around BBB plus to A- kind of range for the average portfolio rating.
So having, at the start we talked about how the fund has crossed the 2 billion mark, which is actually a very remarkable feat, for a Singapore registered fund as well. So what do you think actually appealed to the investors for this fund?
Thank you very much. And this is a privilege to reach that $2 billion mark. And for me, when I look at this fund, I like this fund myself. Short duration, so if you buy into credits, you're lending money to people. You definitely have better visibility in terms of your credit profile of the investment that you buy into. And the other aspect about this fund is that it is short duration. So you basically are quite still away and quite protected against any volatilities in terms be it interest rates or credit spreads. So generally, the purpose of the fund is to be kept stable, and our management also like the fund to be seeing that continuous and slow increase in the NAV for all investors that buy into the fund. So it's something that we are quite confident that we can continue to do it and continue to repeat it for our investors.
Congratulations once again for hitting this mark and many more to come. Thank you, Joyce, for coming here today.
Thank you.